While you view your savings account as a digital vault, the bank sees it as raw material for a high-margin leverage engine. Your 0.5% interest rate is a psychological anchor, while 3% inflation quietly erodes your purchasing power, allowing the institution to capture the spread on the money they multiply through your deposits. Here are 14 calculated mechanisms the banking system uses to prioritize its balance sheet over your net worth. Imagine your capital as a fuel source that you hand over to a massive industrial engine. Most people walk into a local branch with the comforting sensation that they are performing a responsible act of preservation. You likely view those digital digits on your screen as a dormant, protected treasure that might even sprout a few extra dollars over time. However, the reality is that your capital never actually rests. The moment you step back out onto the sidewalk, the institution has already repurposed your hard-earned cash into a high-velocity workhorse. They funnel those deposits into complex investment vehicles, aggressive commercial loans, and a variety of other profit-generating engines designed exclusively for their own benefit. You might see a sanctuary of financial security, but the bank sees a low-cost raw material. While the facade of the industry is built on marble floors and welcoming staff, the actual machinery is engineered to favor the institution at your direct expense. The fundamental truth is that the global financial architecture was never designed to facilitate your personal wealth. Instead, it serves as a massive funnel to ensure the banking system itself remains hyper-profitable. To understand why your balance sheet often feels stagnant, you have to peel back the layers of 14 distinct financial maneuvers that are kept out of the spotlight. These mechanisms range from the subtle way they exploit your cash reserves to the sophisticated psychological hooks that pull consumers into a cycle of perpetual debt. By investigating these hidden gears, you will likely find it impossible to view your local branch with the same sense of naive trust. The first hard truth to grasp is that a traditional savings account can actually be a leak in your financial bucket. We are culturally conditioned to believe that placing money in these accounts is the height of fiscal prudence. The bank offers a tiny sliver of interest as a reward, and you watch the balance climb by a few cents every month. But if you look at the real math, you are frequently moving backward. Consider a scenario where you park $1,000 into a standard savings vehicle offering a 0.5% interest rate. At the end of a full year, you have gained a nominal $5. However, if the cost of living inflation is climbing at a rate of 3%, the actual purchasing power of your $1,000 has been eroded by approximately $30. You may have more paper currency, but you have lost $25 in real-world value. When you scale this over a decade with a $10,000 deposit, the silent theft of inflation becomes devastating. The bank is essentially paying you a pittance for the privilege of lending your money out to others at much higher rates, pocketing the massive difference known as the spread. Furthermore, banks possess a power that most citizens believe is reserved only for the government: the ability to manufacture money out of thin air. This is not a conspiracy but a standard operational procedure of modern lending. When you deposit $1,000, the bank does not lock it in a dark basement. They keep only a tiny fraction of that cash on hand and lend the rest to a new borrower. That borrower then spends the money, and it eventually finds its way back into another bank account, where the cycle of lending and redepositing begins again. Through this constant loop of credit creation, the bank effectively expands the total money supply in the economy. They aren't just storing your wealth, they are using it as a seed to multiply debt throughout the system, charging interest on every new dollar they generate. This structure ensures they profit from the very expansion of debt they facilitate. Within this landscape, credit cards emerge as a premier trap, cleverly disguised as a simple tool for daily convenience. The third revelation concerns the true nature of revolving credit, which the industry markets as a gateway to flexibility. You are enticed by the promise of airline miles, the instant gratification of cashback, and the psychological comfort of buying now while delaying payment until later. To the consumer, a credit card appears as a versatile multi-tool for the modern economy. To the bank, however, it is a high-yield engine of perpetual debt. They do not extract their primary profits from the disciplined user who clears their statement every month. Instead, the real gold mine lies in the interest generated by those who carry a balance. With the average credit card interest rate hovering near 20%, the cost of carrying the debt is astronomical. If you charge a $500 item and commit only to the minimum payments, you could eventually find yourself handing over hundreds of dollars in interest alone, far exceeding the initial price of the product. This transformation turns a simple payment method into a long-term debt machine that keeps the bank's coffers full year after year. Moving to the fourth secret, we encounter one of the most intellectually jarring paradoxes in the modern financial landscape: the higher your net worth, the less you are charged to access capital. Have you ever considered the inherent unfairness of a system where the most vulnerable pay a premium for survival? Banks frame this through the cold lens of risk management. They argue that a client with a massive portfolio and steady cash flow is a safe bet, whereas someone scraping by paycheck to paycheck represents a gamble. Consequently, the wealthy are granted access to cheap, low-interest money, while the poor are sold expensive debt. This dynamic creates a widening chasm in society. Those who are already ahead receive the fuel to accelerate even faster, while those struggling to catch up are weighed down by the heavy anchor of high interest rates, making it nearly impossible to bridge the gap of inequality. The fifth secret lies in the realization that debt is a dual-edged blade, functioning as a sophisticated ladder for some and a destructive trap for others. Most of us are raised with a healthy fear of borrowing, yet the ultra-rich view debt as a fundamental building block for expansion. They utilize low-interest loans to acquire assets that grow in value, such as commercial real estate, scalable businesses, or diverse investment portfolios. When the appreciation of these assets outstrips the cost of the loan, they are using leverage to amplify their wealth. In contrast, the average person often incurs debt for depreciating liabilities, emergency expenses, daily life, or vehicles that lose value the moment they leave the lot. In this context, debt acts as a weapon that erodes the net worth of the working class while serving as a powerful tool for the elite. The outcome is determined entirely by the rate of interest, the intended purpose, and the quality of the underlying asset. Finally, the sixth secret reveals how the banking system assists the wealthy in bypassing the tax collector. When an average person needs cash, they might sell an asset, which immediately triggers capital gains taxes. The wealthy have a more elegant solution: they borrow against their holdings. By using a large block of stock as collateral, they can secure a loan to fund their lifestyle or new ventures without ever selling a single share. This maneuver allows them to maintain ownership of their appreciating assets while avoiding the tax hit that comes with a sale. Banks are eager to facilitate these arrangements because the loans are secured by rock-solid collateral and provide a steady stream of interest income. That means a wealthy person can continue holding appreciating assets while still funding spending or new investments through these strategic credit lines. While the average employee sees their income taxed at the source with zero room for maneuver, the global elite navigate a secondary financial reality. Vast oceans of capital are currently anchored in offshore financial centers and tax havens across the globe. This isn't merely a dark corner for criminal activity. It is a sophisticated playground where major corporations and high-net-worth individuals deploy legal architecture to reroute their fiscal obligations. By utilizing complex intellectual property arrangements, licensing agreements, or a network of subsidiaries, a company can generate its revenue in a high-tax nation but record the actual profit in a low-tax jurisdiction. This paper shuffling, orchestrated by a specialized army of banks, legal firms, and tax consultants, results in a drastically minimized tax bill. It is a level of strategic flexibility that is effectively walled off from the common worker, who remains anchored to standard tax brackets. Consider the 30-year mortgage, which is frequently sold as the ultimate ticket to personal freedom and generational wealth. While equity can certainly grow over time, this financial product functions primarily as a high-yield annuity for the lender. When you sign those papers, you aren't just buying a roof. You are committing to decades of interest payments that often eclipse the original price of the home. Once you factor in the relentless drain of property taxes, insurance premiums, and the inevitable costs of repairs and maintenance, the math changes significantly. To the bank, your home is a predictable income stream that lasts for 30 years. Even if the local real estate market collapses and your home value plummets, the institution's demand for payment remains absolute. If you fail to meet that demand, they possess the legal right to seize the physical asset, proving that the mortgage is a far more reliable wealth builder for the bank than it is for the homeowner. Furthermore, the banking industry has mastered the art of the microscopic harvest, turning minor customer inconveniences into a primary business model. By siphoning small amounts from millions of people simultaneously, they generate massive revenue through a gauntlet of hidden costs. Whether it is a monthly maintenance charge, an ATM withdrawal fee, or costs for transfers and foreign transactions, these line items appear trivial until they are aggregated across a global user base. The overdraft fee serves as the perfect diagnostic for this strategy. Instead of simply blocking a transaction when funds are low, banks often greenlight the purchase specifically to trigger a steep penalty. This fee is frequently absurdly high compared to the actual shortfall, acting as a punitive tax on the customer while serving as a lucrative profit center for the institution. Ultimately, the architecture of our financial world is designed to penalize the saver and celebrate the borrower. Take a moment to analyze the core discrepancy between the pittance paid on savings accounts and the predatory rates attached to credit cards and personal loans. We live in a landscape where fiscal restraint is ignored, while debt is aggressively marketed as a mandatory lifestyle product. From student and auto loans to payday lending and revolving credit, debt has been transformed into a permanent inventory line for financial firms. They push these products because debt creates a captive customer base and a guaranteed long-term yield. Once you are caught in this gravitational pull, your income is diverted toward interest payments that stall your financial evolution. Interest slows progress, and some forms of debt can follow people for years. The internal ledger of a modern bank reveals a cynical truth: the institution often values a debtor far more than a diligent saver. While the public views their deposits as a collection of bills resting quietly in a vault, those funds are actually being deployed as high-stakes ammunition in a hunt for yield. Banks generate their earnings by exposing your capital to significant financial risk through lending and aggressive investment strategies. The catastrophe of the 2008 crisis stands as a grim testament to the fallout when these institutions overextend themselves on toxic financial products and reckless lending. When those institutional bets soured, the consequences were shifted onto the public, as millions of citizens were stripped of their employment, residences, and life savings. In a stark display of power dynamics, many of these entities were salvaged by government intervention, creating a reality where banks privatized their gains in prosperous eras while socializing their losses during a collapse. Even with contemporary regulations, the calm surface of the banking industry masks an underlying current of systemic risk that remains very much alive. Furthermore, the architecture of the financial world imposes a secondary, invisible levy on those with the least resources. In a system that claims to be meritocratic, the reality is that poverty is expensive. While a high-net-worth individual with an elite credit score is courted with rock-bottom interest rates and premium services, the cash-strapped consumer is forced into a gauntlet of high-interest loans, predatory check-cashing outlets, and recurring fees on prepaid cards. This creates a friction-heavy environment where the individuals least capable of absorbing costs are the ones charged a premium for every interaction. It operates as a shadow tax on low-income status, ensuring that instead of receiving a ladder of affordable capital when it is most critical, these users are corralled into the most predatory and costly sectors of the marketplace. The industry also finds immense utility in the widespread lack of financial literacy that persists today. Most educational paths fail to equip students with a functional grasp of compound interest, tax optimization, or the nuances of debt structures. This deficit in knowledge serves as a massive profit lever for lenders. Have you ever wondered why banks pour millions into enticing advertisements for new accounts but spend almost nothing on explaining how to avoid their most expensive pitfalls? Whether by design or fortunate coincidence, a customer who remains in the dark is far easier to monetize. This ignorance leads to a cycle of overpaying for credit, misinterpreting contractual terms, and allowing assets to languish in accounts where their value is slowly digested by inflation. Finally, we must recognize that the entire edifice rests on a psychological foundation rather than a physical one. Banking is a business of manufactured confidence. Because the institution has already lent out or invested the vast majority of your deposits, they do not possess the liquid cash to satisfy every customer simultaneously. If a sudden wave of panic prompted everyone to demand their funds at once, we would witness a bank run, a catastrophic event that places the entire structure under terminal strain. To prevent this, the industry must project an aura of absolute permanence and safety. They rely on the collective belief that the system is functioning perfectly, as the moment that trust evaporates, the physical reality of their empty vaults would be exposed. Banks need to look stable, permanent, and safe. They need customers to believe the system works smoothly. The ultimate glue of the financial sector is not gold or physical assets, but the invisible bond of collective confidence. While we often view these institutions as high-tech vaults for safekeeping, the entire architecture actually functions because we collectively agree that it should. If that psychological trust holds, the gears turn. If it vanishes, the physical reality of the lending model creates immediate instability. However, uncovering this systemic truth should not be an invitation to panic, nor does it imply that banking services are fundamentally a scam or devoid of utility. Instead, it serves as a necessary wake-up call to reframe your perspective on these entities. You must stop operating under the delusion that a bank is a philanthropic organization dedicated to your financial prosperity. They are profit-seeking corporations whose primary mandate is the enrichment of their own balance sheets. When you encounter abysmal savings rates, exorbitant borrowing costs, a minefield of recurring fees, and a red carpet rolled out only for the wealthy, you are not looking at a series of unfortunate errors. These are the deliberate design specifications of a machine optimized for institutional gain. They are features, not bugs. Therefore, the burden of protection falls entirely on your shoulders. Survival in this environment requires you to discard the assumption that your banker is a financial ally or that a safe-looking product will ever generate true growth. You must treat every interaction with the scrutiny of a forensic auditor. Ask the difficult questions, dissect the fine print, and master the core mechanics of interest, debt, taxation, and investing. While the industry is engineered to safeguard its own advantage, your objective is to aggressively defend yours. Reflect on which of these revelations shifted your worldview the most. Note that I am not a financial advisor, and this information is purely for educational purposes, as your ultimate results are a direct consequence of your own actions and strategy.